10 to 11 cities in India. So if you have any support needed from FinIdeas, you can have a local support all this here. Uh, Special case about lockdown. Since the lockdown period of 25th March 2020, FinIdeas has conducted various 116 webinars during this period, and total registration amounting to 21,500 plus, and total participation of more than 13,500. New AUM added under the basket of FinIdeas is 29 crores during this period, and overall fund that we have right now is around 100 crore plus. So this is the profile of FinIdeas. Let's start with the index long-term strategy and look how and what it is useful now. So when we are talking about investment, the first that comes to our mind is property. So let us dig in deep about why people invest in property more. So why property? The basic investment of every individual, some a smaller portion or a larger portion is invested in property. And if you ask everyone what are the primary reason people select property, they will say that property never goes to zero. That means property never loses its value remains there. At least if goes for negative side, then again it can cover and give you returns. So sooner or later, if you stay in property, your investment in property grows. So the majority of the people who invest in property will have this opinion that property is a more safer investment. It never goes to zero, and sooner or later the price of the property will rise and I will grow. Isn't this true? Yes or no? Come on, you can reply me on chat. Very good, very good. So we have understood about the property, but can we say the same thing about equities? Equities is a risky investment tool. It can go to zero. We have seen historically also there are many shares who has lose thousands and crores of rupees of individual investors. So in equity, risk is high, but returns are also high. So we decided that trading in individual securities like Satyam, Arcom can be riskier tool. So we will not trade individual security. What we are going to trade, we are going to trade index. So any of you can tell me any name of the index you know? Come on. Can you type the name in chat? Very good. Very good. Okay. The Sensex is the index for BSE and Nifty is the index for NSE. Very nice. So what is happening now? Let's take an example of Nifty first, right? So why we select Nifty as an investment? Nifty is a tool of 50 market capitalization shares. That means the top 50 companies of India are included in Nifty. The average of that share is the price of the index. So there are shares like Reliance is part of the index. You must have heard name of HDFC Bank, TCS. All these shares are part of the index, top 50 shares, right? And many more. But there was a time when Satyam was also into the index. Arcam was also into the index. But as soon as their valuation, their capitalization fall below 50, that means it reached to 51, they were out of the index. So simple mathematics there for index. If any shares loses its market cap below 50 and it reaches to 51, it will go out of the index. And the next company which was on 51 will reach into the index. This is the philosophy by which index is managed. So this this kind of concept gives a surety that in at least index will not be can be never be zero. How? Look, individual share Satyam can become zero, Arcom can become zero, even Reliance has a potential or in future may lose its value. But when you are investing in a concept log like index, where there are more than one stock or 50, for example, in Nifty, there are 50 stocks, and any of this share which falls below the average mark, capitalization or average mark, it goes out of the index, and the share which is performing good is coming to the index. That makes sure that you always have a top performing share in your company, in your basket. If you consider the Reliance market cap right now, it is around 9 lakhs crores. Similarly, HDFC Bank is around 8 lakhs crore, PCS is around 6 lakh crore. So if I total the 50 companies market cap, it's around 90 lakhs crores. That means if I pay 90 lakhs crores check, worth of check, I can purchase all these 50 companies. This is the market cap. So this 90 lakhs crore is equal to 12,000 of Nifty. If you consider Nifty as 12,000 today, so 90 lakhs crore has to be the value of the total market cap of all these 50 companies. Now, I have one question for you. Today's richest company, that is of Reliance, is of 9 lakhs crores. That's a very intelligent question. I need an answer from you, everyone. Today's richest company's market capitalization is 9 lakh crore. Can you say me after the 10 years period, which will be the India's most whichever will be the India's most richest company in terms of market capitalization, what will be his market cap? Either it will be above 9 lakhs crore or below 9 lakhs crore. Come on. Very good. Very good. So it has to be more than 9 lakhs crore. If 9 lakhs, if top most companies valuation after 10 years is going to be more than 9 lakhs crore, that means this 90 lakhs crore total valuation of market capitalization will also be more than that, right? So indirectly what we are saying is that sooner or later, the second point that property gives us, that sooner or later if you stay on, it gives you the profit or rise. Here also you will have the topmost company in India, whatever it can be Reliance, it can be anything. After 10 years it can be a Patanjali also. We do not care about that, but we are, if we are investing in index, we will make sure that you have the best company to invest even after the period of 10 years also. So property used to give us two advantages. First, it will never become zero, and sooner or later if you hold on to that, the price goes and you make the profit. Now index as an instrument gives you the same two, right? It gives you the confidence that it will not become zero because of the mechanism by which it is managed. The good companies will be always automatically be included into the index, and companies which are not performing will automatically be thrown out of the index. And if you stay on to the longer period of time into this investment, like property gives you the confidence that it will grow, even index will grow. So this were the benefit of properties. Same benefits are we can reach by equity investment in Nifty also, yeah, index also. So let's have a poll first. I'm giving you a poll right now. What you have to do, you have to answer yes or no. There will be a flash on your screen for poll. There is a poll on your screen. How have you done any investment in equity or mutual fund till date? You either have to select yes or no. Very good. Okay, the polls end in 5, 4, 3, 2, 1. Okay. So almost all the participants who have responded have shown that they have some investment in equity or mutual fund. Very good. That's a very good thing to share. That means all the participants today are having a very pretty much good experience about equity market. So let's, this was the one part of the presentation today that we are going to have. Let's go for the second part. What we have understood so far is that equity is a risky instrument, but we can lower the risk by investing in index. But our target, we are not satisfied with lower risk also. Our target is to reduce the risk. So equity plus safety is equal to prosperity. The higher the safety, the better will be the prosperity. So what we are going to do, let's take an example. For example, Nifty is around 10,000. And if you buy a safety for that, that is put option, for 1 year, it will cost around 5%. So that means 500 rupees. So we'll buy this safety along with the Nifty shares. So total cost for Nifty for me will be 10,500. So for others, Nifty they bought is at 10,000. For me, for this year, the Nifty is bought at 10,500. But what is the benefit that I'm ripping out of is that if I invest 1 crore at 10,000 price of Nifty, I'm getting a surety that at whatever movement I will get minimum 95 lakhs rupees back, isn't it? This is the benefit of having a safety or a put options, which gives you benefit that if market goes to 5,000, 6,000, 7,000, any level, my 1 crore of investment will at least be returned back 95 lakhs rupees. Yes or no? So that is the benefit of having a safety. But it is not coming free. You can see that it has a cost also. So let's understand the downside of that also. So for example, let's take the worst case scenario that I'm investing in index in 2020, even after 5 years of investment in 2024, and Nifty of 10,000 remains 10,000 only after 5 years also. So what will happen to my 1 crore of investment? So let's take an example of this, a hypothetical example. Let the Nifty movement was like in 2020 it was 10,000. After 1 year it was 12,000. Again it fall back to 8,000, and 2023 it was again rise to 12,000. Again there is a fall of 10 to 10,000, and this is how Nifty remained 10,000 to 10,000 in 5 years. This can happen. We have seen in current year also that Nifty has fallen up and risen back again to the level. So this can happen. So let's look at the investment. Let's look at the value of the investment, what we have done and what has happened to that. So if you take an example of 1 crore rupees, let's take what we do will, because we have understood the benefit of hedging also, that is safety. So we have to pay 5% of 1 crore as a hedging cost or a safety cost, that is 5 lakh rupees. And after 1 year, that is 2021, market has risen to 12,000. Look, this is a very important moment of the presentation. If you understand this point now, this is the crux of the all the presentation we are giving to give you. This is the crux of that. This is the crux of IELTS. So please listen to it over here. So if you invest 1 crore and take a protection of 5 lakhs rupees on 1 crore, in market after 1 year resist to 12,000, what will be my profit on 1 crore? Come on, give me a reply on chat. Come on, very good, very good. So it will be 1.2 crores. I will have 20 lakhs rupees of profit, right? My 1 crore of investment will rise to 1.20. Of course, 5 lakhs rupees of cost will be deducted. We are going to write it separately right now. Now again, I have to pay the insurance cost because now my fund value is 1.2 crore rupees. I have to pay 5% of that. So now I'm going to pay 6 lakhs rupees, right? Very good. Now intelligent question. Market has risen from fallen back to 8,000 rupees from 12,000. What will be my value of fund? Come on, Give me a reply on chat. Very good, very good. Very good. बहुत अच्छे. Very good. So my 1.2 crores of fund will remain same. What is the reason for that? Market has fallen, but because I have taken the safety of put options, it has given back the whatever loss amount that I have made in equity is covered by the put options. So my fund remains same. So now again I have to pay my safety cost for 2022 also. So what will be that? Can anybody give me the reply on chat? Very good. बहुत अच्छे. Very good. Very good. So I have to pay 6 lakhs rupees. Again, 5% of the value of fund that I have. This is the exposure that I am having. This is the value of fund I am having. So what will happen now that market has from 2022 level of 8,000, it has risen to 12,000. Now 50% of rise is there. So what will be the value of my 1.2 crore of fund? Come on. Very good. बहुत अच्छे. Very good. Very good, everyone. So from 1.2 crores of fund, it has 50% rise in market. So my fund will also rise 50%. That is 1.8 crores. Again, I have to pay back my hedging cost over here. So on 1.8 crore, I'm paying my hedging cost of 5%. That comes to 9 lakhs rupees. And market has fallen back to 10,000 rupees. So what will be my value of fund at the end of 2024 when market remains at 10,000? Everyone, please come on, reply over here. My 1.8 crores of fund will be what? Come on. At 2024, when market has fallen from 12,000 to 10,000, what will be my value of fund? Very good. बहुत अच्छे. So it will remain the same, that is around 1.8 crore. So what has happened actually? So whenever you see market is rising, you are getting the benefit of that. But whenever market is falling, your value of fund remains the same. Of course, you are paying the hedging cost. So if you include all these hedging costs, that is 5 lakhs, 6 lakhs, 6 lakhs, and 9 lakhs, around 26 lakhs rupees. Even after that, also my 1 crore of fund has risen to 1.54 crores. So actually, we are, even after paying this safety cost or hedging cost, we are making good amount of profit. The reason because of that, this safety cost is actually not a cost. What we are paying this for is that we are actually paying for the future fall of the market. So it's more like a medical insurance that you're paying. But first of all, medical doesn't necessarily you take a claim. So you're not losing, you're losing the premium. But in 4-5 years or 10 years of time, one claim can settle all that premium amount. So what actually you are doing, you are making a small amount of premium payment every year so that a big amount of medical claim has to be not settled by you, it can be settled by the company. So you get the benefit of that. This is exactly what is happening to your portfolio. You are paying small amount of premium every year so that a big 40-50% of fall like that we have seen this year will not impact your portfolio. So even market remains the same and we are growing. If we consider the past performance of this kind of strategy for last 70 years, Nifty and the ILTS, if we compare both of them, Nifty has given return of 12 times. It has risen 12 times in last 17 years. Whereas the concept of ILTS has given return of 17 times. And this period of time, there was a risk of 52%. That means there was a time when Nifty has given negative 52% of return in a year. But in this strategy, a maximum that you have shown over here is 5%. So maximum risk you have taken is over 5% over here. Sorry. So if anybody says that high risk is equal to high return, that's a very wrong statement to make. A smart calculated risk is equal to high return. So Warren Buffett, the best investor we have in the world, around 70 years of investment experience. What the primary rule of his investment is, never lose money. And rule number two, never forget the rule number one. So he also prefers to have a safety in his investment. He prefer investment for a longer period of time with, and he advises people to not to lose money and focus on that. So we have also developed a strategy based on that concept only. Okay, and second poll coming to you is that, do you understand the basic of call options and put options? So everyone, please answer me. The poll question is, do you understand the basic of call options and put options? Very good, very good. बहुत अच्छे, very good. Very good, very good. The poll is ending in 5, 4, 3, 2, 1. Okay, so almost 80% of the participants understand the call and put options. That's a good number to have. So let's start the presentation further. This will help us understand the major concepts that we are going to understand in future right now. Okay, let's start the presentation. So now what we are going to do, we are going to understand this strategy with an example. Let's take an example for relax plan. What is relax plan? Let's understand that. Suppose a person wants to invest 1 crore, right, with protection. So what he has to do, what we can do with his 1 crore rupees over here is that we can divide 1 crore in two parts. That is 30 lakhs of equity and 70 lakhs of debt. This is a very interesting and very important session of part of the session. So please concentrate right now. We'll take questions after this example, right? Okay. So 1 crore of investment, a person having an investment capacity of 1 crore, this is an example, right? So out of that, 30 lakhs will be parked in equity. 70 lakhs rupees is available for debt, right? So we have bifurcated that money in that way. So what we'll do, for 30 lakhs rupees, we'll buy index ETF of 30 lakhs rupees. We can use that stocks of index and put them on collaterals. What will this help us is, if you put the stock on collateral, we get the benefit of using them for future positions. Now this is as good as loan. We have purchased equity of 30 lakh rupees by cash, and we have taken a loan of 70 lakh rupees to purchase the future, right? So 70 lakhs rupees of exposure to future, that is loan. Then total exposure, that is 100 lakhs, is equal to 1 crore that we have taken, right? So whatever now profit is going to come is also on 1 crore, and whatever risk is also is on 1 crore, right or wrong? Yes. So by making these two trades, we have created a portfolio of 1 crore. It is, if you compare it by property, now if you are going to purchase a property of 1 crore, 30 lakhs rupees we have given, and we have taken a loan of 70 lakhs rupees, and we are paying interest on that, right? So first thing that we understand in this presentation was that we should not take unlimited risk. So what will we do first is to protect our portfolio of 1 crore from downside risk. So we'll pay annually 5% for that. That is around 5 lakhs rupees on 1 crore of exposure. Now our second cost will come over here, is that is a future cost. Since this 70 lakhs rupees we have not paid from our pocket, there will be a financing cost on that. That financing cost is around 5% yearly, but that is on 70 lakhs, not on 1 lakh rupees, 1 crore rupees rather. So it will be around 3.5 lakhs rupees. So total we are paying 8.5 lakhs rupees as a cost, and both these hedging as well as financing cost, what is giving is that we have now portfolio of 1 crore. We are downside protected. The maximum risk that we are going to have is 8.5 lakhs rupees as of now. But still we have 70 lakhs rupees ideal available with us. What we can do with that? We simply can park them in debt. A general debt return that we can expect yearly is around 7%. So if we even generate 7% on 70 lakhs rupees, that comes to around 5 lakhs rupees. So the 70 lakhs rupees that we had additional over here, we have earned 5 lakhs rupees of interest over there. So maximum risk that we have taken over here is around 3.5 lakhs rupees. So what does it mean? That on the portfolio of 1 crore, the maximum risk downside you are taking is around 3.5%. So this is the maximum risk you are having in relaxed plan. So this is a smart way of using debt to reduce further cost. So any question till now? Everyone, you can write your question in chat if you want. Very good. Okay. Okay, so should we move on then? Okay, I have a question. Just a minute. Mr. Sivaraman, the options we are talking is about yearly options. In Nifty index, we have options up to 5 years. Okay, so we are talking is a yearly option over here, not a monthly options, right? So that's your answer for now. So let's move further. Now, what we have understood over here is that how a debt and equity combination can be used smartly to reduce overall cost of our fund. Right. Now let's have one more plan. Let's talk about basic plan. How this plan is useful. Let's understand. Look, many of the people have existing debt. Like it's like people have home loans, property loans. Other than that, any business loans you have, any other liabilities that you have, which is you are having more than that, more than 7% of debt you are paying, interest you are paying. So how can you utilize that part? We have understood that 8.5 lakhs rupees is the cost that we are paying over here, 5 lakhs rupees for hedging and 3.5 lakhs rupees for financing. But 70 lakhs rupees in other investment business, what we can use that money rather than paying to us. You can use that money in your business. You can use that money for paying your debts, whatever you have, right? And if you even consider that your average debt loan that you are having is around 9%, then yearly you are saving around 6 lakhs 30,000 around on that. Now, what does it mean? That net cost now has reduced from 3.5 lakhs rupees to 2.20 lakhs rupees. That means if you utilize this 70 lakhs rupees smartly, you can further reduce your cost. Look, these are different ways to invest in an index by which you can reduce your cost also and can generate better yield on upside. So now let's understand power booster also. Many people who are having existing portfolio, we have taken a poll where I have asked you that how many of you have present invested in equity, and 100% was the reply. That means most of you people have equity and mutual fund exposure. You can utilize that also very smartly. Let's look how we can use. Suppose a person want to create a portfolio of 1 crore, want to invest 1 crore rupees, what he can do, right? Rather than paying 30 lakh rupees cash, what he can do, he can pay 10 lakh rupees of check only. If he have 30 lakhs rupees of stocks available with him, it can be mutual fund, it can be bonds, it can be direct equities, whatever he has in DP, right? He can give that stocks as a collateral. We can create portfolio of futures only of 1 crore rupees. right? We will have profit and loss over here is on 1 crore totally. So overall cost over here of hedging will be 5%, that is 5 lakhs rupees, and financing cost will be also 5% on 1 crore of fund, that is 5 lakhs. So total cost that we are paying is around 10 lakhs rupees. That is the check that we have paid. But what is the benefit? 90 lakhs rupees is still ideal with us. We can use that money for our business or pay our loans, whatever we have, and if we generate 9% on that, that net cost can reduce to 1.9%. So this is how smartly you can use the combination of debt plus equity or your existing portfolio to create another portfolio and utilize that money for your business or loan purposes and create a portfolio of 1 crore. Okay, so if anybody has invested in index long-term kind of strategy from 2002, and suppose this is a table for 1 crore of investment, what he has to do, he has to invest 1 crore at a start, right? So what has he has seen so far? So market from 1100 to 1800, there is a rise of 71%, whereas this strategy has made 68% return. 11% of Nifty return, 7%, 36 to 32% return. When there is a fall of 52%, the strategy is given negative return of only 4%, 25% of negative return, 4% of negative return. So whenever you see, whenever market is rising, you are giving return almost near to the Nifty. But whenever there is a fall in market or in index, your portfolio is almost very much protected downside. So this way, for last 17 years, the person who has invested 1 crore, the value of that 1 crore is 17 crore 46 lakhs rupees at the end of 2000, at the time of 2020. So what is the risk return profile? Annual risk around 4% and compound annualized return is around 18.9%. This is a risk return profile of index long-term strategy. If we see it graphically also, this is a return of a particular client who has traded this strategy for 2014. This is the actual return. You see that graphically also it is somewhat near to the Nifty, but there is a fall in Nifty around 2014 end. And because of that, here Nifty index red line of index has ILTS has started outperforming that. So whenever there is a fall, here is a fall, but index long-term strategies fall is slightly lesser than that because of the hedging where you have. Again, there is a fall, but the fall in Nifty, fall in index long-term strategy is very less. That is a risk we are talking about. So whenever there is a fall, the risk that index long-term strategy is lesser, and because of that, we are able to outperform Nifty. If you want to see it figure by figure also, like for example, this is a percentage return. That means if Nifty and ILTS both start with 100 rupees, at the time of 18 Feb 2015, Nifty has given 100 rupees in Nifty was 114, and Nifty ILTS was 120. There is a fall in 2016. 114 rupees now has fallen to 90, but in Nifty it is 112. It has fallen only 8 rupees over here. Again, when there is a rise, we have Nifty went back to 115 around, and ILTS risen to 141. Same way, there is a fall in at a COVID period of time when Nifty was from 158, it fall to 97. So 100 rupees in Nifty was 159 around, which fall back to 97. So almost all gain of Nifty was evaporated from market if we have invested in Nifty. But here 187 of ILTS has fallen back to 171 only, and again when market recovered, Nifty has given covered all his return, but here we have outperformed because of the hedging we have. So whenever there is a fall, we are able to outperform. So there are one more part I would like to explain over is systematic withdrawal plan. What is this systematic withdrawal plan? People near to the retirement age always prefer to have a plan where they can also withdraw some money for future expenses. So we have planned a way in which where they can also use this index long-term strategy in terms of withdrawal plan also. So person taking an exposure of 100 crores, sorry, 1 crore, and he has to pay 1 crore for that, obviously, to create a portfolio of that. He can always withdraw monthly 0.5%, that is around 50,000 rupees for his expenses as a withdrawal, systematic withdrawal plan. That yearly he can withdraw 6% of that. If somebody has invested in that way, that means from last 70 years, somebody has done a SWP in index long-term strategy, what would we have? He would have invested 1 crore at a start. Every year, 0.5% monthly, yearly 6%, that is 6 lakhs rupees he must have withdrawn. So after 70 years, that means all his 1 crore rupees has been withdrawn in terms of SWP. But still, his portfolio value will be around 14 lakhs 96,000. So that means even after withdrawal of 6% yearly, he still have a portfolio of around 15 crores available with him. This is a power of equity. So in SWP, he has to invest 1 crore rupees in equity. Annual withdrawal, he can have 6 lakhs rupees. Total withdrawal for 17 years is 1 crore and 2 lakhs rupees. So net liquidation value, that means if he withdraw all his profit from the market, still he has 14 crore, 14.95 crores left in his pocket. That means the profit of 14.97 lakhs during this 17 years of period. Many people as an investor do compare SWP with fixed deposit. Said like even fixed deposit can give you that kind of advantage. So let's take an example of fixed deposit with SWP in index long-term strategy. A person investing in FD in 2002, assuming a 6% FD rate of 1 crore, and if we withdraw same amount, like we have a 0.5% every month, what is NLV in 2019 end? His 1 crore is still 1 crore rupees. That means his 1 crore remain only 1 crore rupees, and net PNL he is having 1.02. That means he has hardly risen 2 lakhs rupees over there, and he, of course, he has withdrawn 1 crore rupees as a systematic withdrawal plan in fixed deposit monthly of 0.5%. But in SWP, in index long-term strategy, if he invests 1 crore rupees, even after withdrawal of 6% every year after for 17 years, he still have left around 15 crores in his portfolio. That means he has earned around 14.97 crore. So even after having a withdrawal of 6%, he has negligible profit in FDs, whereas in SWP in index long term, he could have a 15 crores of net value as a profit. So as we discussed, 1 crore was an example. Investor can start, if you want to start investing Nifty like index long-term strategy. Nifty. So we are taking example of Nifty running at 12,000 rupees, which is around that 12,000 into 75. So minimum of 9 lakh rupees you can start with, right? You have different plans to start with, as we discussed, Relax, Basic, and Power Booster. In Relax plan, you have to pay 100% check. Basic plan, you have to pay 30% check. Power Booster, you have to pay 30% stock plus 10% check only. So in value terms, it is in Relax plan, it is 9 lakhs rupees. Basic plan is around 2,70,000 rupees. In Power Booster, you are paying 90,000 only. In Relax and Basic plan, you do not have to have any stocks, but if you choose Power Booster, we believe that you must have around 3 lakhs rupees of existing portfolio which can be used as a collateral. What FinIdea's commercials are, FinIdea's charge you fees on 6 monthly basis. So exposure of below 1 crore will be charged at 0.75 rupees of AMC, percentage AMC, and portfolio between less than 5 crores, between 1 crore and 5 crores will be charged at 0.62.5% every quarter, every 2 quarters, that is 6 months, and portfolio above 5 crores will be charged at 0.5% quarterly, 2 quarters, that is 6 months AMC, and GST will be extra. So if we compare the charges that Finadias charge with other investment tools like mutual fund, PMS, what can be the difference? Mutual funds normal expense ratios are around 1.75% around. PMS charges up to 2.5% also. But ILTS, the average cost that we yearly, if we assume, is around 1.25% only. Reason we are able to charge less is that we are saving a lot of cost. We do not have to indulge in a lot of research. We have our own algorithm, so we are able to generate our own systems by trading platforms also. So we can use our technology to give you better services. So the reason, because of that, we are able to pass on the benefit to you. If you invest in equity, let's take a comparison of investment also, by which way how much we have to invest for exposure of 9 lakhs rupees, right? In equity, MF or PMS, you have to invest totally 9 lakhs rupees to take an exposure of 9 lakhs rupees. Here also you're taking 9 lakhs rupees only. But what is the difference? If market rises in equity or PMS or mutual fund, by 100%, that means 9 lakhs rupees will reach to 18 lakhs rupees. But when you're talking about index long-term strategy, here you are getting slightly less return because of the hedging cost that you are having. That is 17.7 lakhs. It is almost to 18 lakhs rupees. So similar return. But if market falls 50%, then your 9 lakhs rupees will go to 4,50,000 rupees in other revenues. But here in long-term strategy, your maximum fall you are having is 30,000 around here. That is 8.70 lakhs. Net value still you are having intact. So risk is very low. Returns are very similar to what you are having over PMS, equities, and mutual funds. So to summarize, Relax Basic and Power Booster plan, right? It is annual cost in Relax plan is around 35,000 rupees. Basic plan is around 76,000 rupees, and Power Booster is 90,000 rupees. Interest saved is around in Relax plan, since you are paying 100% of capital, you do not you're not saving on interest, but you can use in Basic and Power Booster. You are having idle fund with you yourselves. You can use that money for business and other purposes for paying your loan. So you are generating interest on that. So interest saved will be around 58,000 rupees in Basic plan, as well as 72,000 in Power Booster. So net that we are having is net cost is around 18,000 in Power Booster, 18,000 in Basic plan also, and around 35,000 in Relax. So this is how it is. So let's summarize our discussion of today that we had. Index long-term strategy is a combination of equity and future. We are always downside protected. It is an index-based strategy which invest in the Nifty index of NSE. Low risk strategy. We have seen that the risk is very low over here. We have questions also. Okay. We have seen the past record of this strategy for the last 17 years and 6 years of live track record also, which has showing we have able to outperform Nifty with lowest risk possible. We give you live back office access also, which can give you rights to see your live accounts also. We have a systematic withdrawal plan for you. There is no locking period over here, but it is ideally assumed that it's a long-term strategy, so your horizon should be 5 to 10 years. We have a dedicated team of Finadias in sales as well as support, where we dedicatedly are doing this thing only. We have systematic advisory through algorithms. We have our own developed algorithms which tracks all the opportunities related to this. IELTS, and continuously update you for the advisories. These kind of investment tools can be used for retirements and higher education for long-term purposes. And most important is that all these things can be done in your own client account. So that means you are not going to give money to any individual. It is going to be available in your trading account. All rights are within your reach. So this is the advantage. Your money remains with yourself only. Okay. Updates from do you want updates from FinIdeas? You can subscribe our I think Silas has given some details on chat also. You can see that details also. You can subscribe our Telegram, Google reviews, and you can also, to know more, there is a link given to you. You can subscribe. Link is available over there in chat also. You can use that link to know about this strategy as well as FinIdeas, so that our team can get in touch with you and give you replies over there. I will also request you to go to Google reviews. The link is set by Silas over here, and give us a review about feedback that you about this webinar that you have attended. Furthermore, we are also having on 24th we are having another session on futures, basic of futures and option, where we are going to discuss about how margins, how profit and loss, and how payoffs are going to be calculated. So I will request you to share the details with your friends and relatives, so that they also can get the benefit of understanding the concepts of derivatives, which is very easy. So you can register for that from our website, and link will be sent to you also. Any question is entertained. Yeah, the platform is open for the questions, please. Okay. I suppose everyone has received all the links in chats, right? So do take note of that. Thank you for your time. It was really nice talking to all people. Thank you, FinIdeas team, also for your cooperation. Everyone, thank you for your time.